Is the Fed lying to us about jobs? If that was the case, then you would expect to see some statistics that would contradict what the Federal Reserve is saying is true. And that is exactly what I'm going to show you today. The jobs data that the Federal Reserve is looking at is not only misleading, but it's flat out wrong for an assumption about the way the economy is working right now. They're pointing specifically at very niche, cherry-picked jobs data to say the economy is strong so that they can continue to try and crash it. Meanwhile, the economy is actually in free fall, and this is proven by, other than jobs data, something in the yield curve that hasn't happened since 1980. I'm going to show you some charts from an article from Mises.org that I sent out in my free weekly newsletter this week. If you'd like to start getting that, link is in the description below. This first chart is about not seasonally adjusted month-to-month change in employment. You'll see gray bars and blue bars here. What you'll notice is that the blue bars are full-time, the gray bars are part-time. Since September of 2022, the employment growth has been all part-time and all the full-time job growth has actually been negative. So those gangbusters jobs reports that they keep on pointing to and saying, hey, more people have jobs, the economy is strong, we need to keep on fighting inflation. Guess what? That is not true. There is job growth, but it's part-time job growth. Full-time jobs are actually on the decline. Now, is this just less good data or is this actually bad data when looking at the health of the economy? A growth in part-time employment at the same time as a decline in full-time employment is a very negative signal for the health of an economy. It means that employers are actively moving forward with cutting down the amount of hours that they are giving to their employees. They're only hiring part-time because it's way cheaper considering all the benefits and extra compensation that you give to full-time workers. This also means that there are people, many people, who are loading up on 2 and sometimes 3, sometimes even 4 part-time jobs just to make ends meet. This is not the sign of a healthy, growing economy. This is the sign of struggling households all across the nation. Now, you can find this data very easily yourself by looking at the difference between the establishment survey and the household survey for jobs. The Fed looks at the establishment survey, which does not differentiate between one person having multiple jobs or multiple jobs being taken up by multiple people. The household survey does, and so if one person has 3 jobs, it's not going to count that as 3 jobs. It's just one person. And if we take a look at this chart that goes back to 1981, we can see the dark blue line that shows full-time employees and the gray line shows part-time employees. The year-over-year change in full-time employees has been dropping off a cliff. Meanwhile, we've seen a recent but sizable spike in part-time work to compensate. The reason this is alarming is because, number one, it does signal economic weakness, not strength, and that shows up in the fact that recessions typically happen after you see this sort of trend and this spike reversing. If we take a look at the exact same thing, it happened in 1981, 1990, 2001, 2008, and February of 2020. A big decline in full-time work with a spike in part-time work is a signal that we are in or near a recession. This, with many other data points, the Federal Reserve is choosing to look at intentionally so that they can continue to ratchet up their tightening. They do not want to have any political excuse right now, any pressure to let off the brakes. They're actively trying to crush the economy and crush the consumer. You don't even have to read between the lines looking at their statements to understand this. They've continually said for months now, prepare for pain. We're trying to increase unemployment, bring these jobs numbers down. They want to take away your income so that inflation stops, which, by the way, the inflation was their fault by all the printing that they did in the first place. So in order to save you from the crash in 2020, they printed trillions of dollars and eroded the value of your savings and your wages. But now that that's causing runaway inflation, they're trying to save you from inflation by taking away your income and your job and giving you the crash that we would have had in 2020. Meanwhile, we just had the inflation on top of it. And yes, incomes have gone up over the last couple of years, but inflation has gone up more, which means that virtually everybody has seen an increase in pay. The average person might have gone from making $100,000 to $115,000 over the last 2 years. But at the same time, their cost of living went from $100,000 to $120,000 or $130,000. In real terms, that's a pay cut, not a pay raise. And that is the Fed's doing, not your employer. Now, it's not just the jobs data that is signaling coming economic pain. We are seeing this show up in other areas, specifically the bond market. The Treasury yield curve is inverted more than it has been since the 1980s. An inverted yield curve is a signal of coming economic pain. The way the yield curve normally works is that the longer the maturity, the higher the interest rate. That makes sense. If you're not going to pay back your debt for 30 years, you'd expect to pay a higher interest rate than you would if you were going to pay your debt back in 15 years. There's more risk, more time for something to go wrong, more time for inflation to erode the value of those dollars that you're paying back. But sometimes the yield curve inverts and you can get a lower interest rate by borrowing at a shorter term than the longer term. So why would this be? 2 reasons. One is manipulation and one is free market. Manipulation means, hey, if we expect the economy to completely crash at some point in the future, the Fed might come in and lower rates to deal with it. And so there's a greater chance that the economy crashes in the next 10 years than there is in the next 2 years because there's more amount of time for that. And so right now, the yield on the 2-year Treasury is almost 4.5%, while the yield on the 10-year is 3.7%, because there's greater chance that the Fed will have to lower rates in the next 10 years than there is in the next 2 years. So the market is discounting that probability and baking that into the interest rates. But there's also a free market answer to this as well. If the economy crashes and everything slows down and there's a lot of deflation and prices collapse, that means the value of dollars goes up. That means savings will eventually be replenished, and that means the incentive will go the other way. Yes, interest rates will be higher during that time, but then as recovery gets going and there's more savings to be lent out, that will push the market rate of interest down. So if you expect the economy to crash in the short term, then you would expect those short-term rates to be higher than those long-term rates. So while it's a combination of both expectation of Fed manipulation and also natural free market movements, the inverted yield curve is a sign that trouble is brewing. And right now, we are seeing the steepest inversion that we have since 1980, over 40 years. The 2-year yield is over 86 basis points higher than the 10-year. During 2020 and 2021, it was very popular to say, don't fight the Fed, because the Fed was printing money and it was making it easy to feel like you were getting rich by buying things because the numbers just went up as a result of all the newly printed money coming into the system. Well, the same is true right now. When the Fed tells you we're going to crash the economy, we're going to make things slow down, there's going to be economic pain, we're going to take your jobs away, believe them. We are going to have deflation this year. Not disinflation, deflation. We've already had it month over month. We're going to have it year over year. We're going to start to see prices falling. We're going to see economic pain. Prepare for it, because believe the people who have control of the money are going to do what they say they're going to do, which is take away your income. And if you're looking at this, which I hope you are, as an opportunity to take advantage of really world-class assets on sale, but you just want to make sure that you know how to identify when those stocks are actually on sale, they're actually a good deal, get my bear market investing guide linked in the description below. As always, really appreciate you guys. Thank you so much for watching. Have a great day.